Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields continue to grind higher, testing that 288 level we earlier tested this week, and probably still targeting 3% is really the bullseye here that we've been talking about, not only this week, last 2 weeks, but really that's been the target since probably going back into mid-December. And I think that a lot of people thought that target was a bit exaggerated. Maybe it was going to be a year-end 2018 target. Well, lo and behold, we're in February of 2018, and we're pretty much already there. So right now we're seeing the technicals kind of thrown out the window. We've got a little bit of a top building at this 288, 290 level, but that probably won't hold. And I think the only thing keeping stocks or keeping yields from going up to 3% today was the fact the stock market collapsed again, and that's kind of drawing some attention away from the Treasury market. But lo and behold, all signals are pointing towards 3% sooner than later. And if you look at market volatility, yes, we are starting to see a little bit of a trend of higher yields, but because we're in uncharted territory, market volatility is skyrocketing in treasuries. And I say skyrocketing because we're at levels not seen since the early part of 2017, certainly well below the 2017 highs. But when we're talking about 5% treasury volatility, that's something we haven't talked about in almost a year. So it's been a long time since we've seen volatility on the rise at this rate. Likewise, the uncertainty of where we're going, it's not like we're in a range and we just broke out of the range and go back into the range like we've seen in the past. So this again is an uncharted territory. We're seeing volatility spike higher. And part of the reason we saw this week we had some auctions with lackluster demand. And now that really doesn't echo a whole lot of trouble for the Treasury market. It absorbs supply very well. But when you talk about the supply that could be coming to market, we talk about the Fed stepping aside, not being a buyer, and we talk about the trillions of dollars needed to fund some of the budget items that the president has noted, it does start to possibly become a problem if you can't find buyers for them, at least at current yields. So I think right now that these auctions could be a signal to the market that, hey, we need to start building up. We need more demand on the bond side. And some of the selling in equities, I think, will cause natural demand into bonds. But I think ultimately they have to find more buyers, or at least spread themselves out, because this week's auctions were not a spectacle of demand, something that the Treasury definitely needs if they're going to sell bonds heading into this year in order to fund what is necessary. So yields continuing to climb higher. 3% is certainly right around the corner, but we need to see stocks level off before we get that jump. This is Todd Colvin coming to you from the floor of the CME Group.